France passes its first bond auction test of the year, but the euro falls further. The rising dollar hits oil and the financial crisis in Hungary deepens. This is trading at 12, the European Market Pulse. So investors shrug off concerns that France might soon lose its AAA credit rating, buying almost €8 billion of long-dated bonds at auction. For more, I'm joined by Luka Jelinek, European Head of Rate Strategy at Crédit Agricole. Luka, a decent auction, the full €8 billion targeted was sold and demand was strong, but yields were mostly higher. So is it glass half full or glass half empty?
I think from the point of view of the government, it has to be half full. The big question that all the European governments have faced is how easily can they access the market, how easily can they raise liquidity. In that sense, I think the result was reasonably encouraging. The bids were a little bit up, nearly 15 billion. The bid cover was up from the last auction and roughly on average for 2011 levels. So I think in that sense, it went fairly well, and also the tail on the 10-year was a little bit shorter. It was about 1 cent less per billion placed.
Okay, so where do French yields and spreads over bonds go from here in the near term?
I think we're going to see, probably after the auction, a little bit of a retreat in spreads. Yields aren't really going to drop very much because obviously there tends to be an opposite reaction when spreads tighten in for bond yields to rise a little bit. But I think in absolute terms, we're not looking for major changes in French yields. I just wanted to point out that although the 10-year had a shorter tail, there was a longer tail in the 15 and 30-year bonds. So it's not a blowout auction by any means. It just shows that despite the ratings concerns, liquidity is still pretty good on that market, but spreads will come in very gradually. There are still a lot of problems in the euro area.
My thanks there to Luka Jelinek at Crédit Agricole. The euro not faring quite so well today though. It fell to a fresh 15-month low against the dollar and an 11-year low against the yen. And it's not just short-term traders and speculators selling either, as Reuters FX analyst Jeremy Bolton explains.
Recent down moves in euro-dollar have been driven by speculators. That appears to have changed now. We're seeing real money come into the fray and buying a lot of dollars across the board. Essentially, it's been influenced by the down move in euro-dollar, which itself has been dictated by option barriers at different levels. We've broken today 128.5. People are now looking at 128. They're not looking at the move to speed away to the downside, particularly because the market's already so short of euros. So we're going to see a gradual decline, not a rapid set-off to the downside, but the break below 128.5 has now got traders eyeing levels as low as 125.
So that dollar rally and the unwind of leveraged or risk trades weighing on oil. Traders shrugging off a Reuters exclusive that EU governments will impose a ban on oil imports from Iran. Brent crude slips to $113.5, approaching technical support at the 200-day moving average, which today comes in around 112.75. And finally, investors continue to dump Hungarian assets, increasingly worried about the government's policy course and prospects of securing EU and IMF aid. The forint hit a new low against the euro, 10-year bond yields surged above 11%, and the debt agency was forced to cut the value of a bill auction. Well, before we go, a quick check on where European stocks are trading. The FTSE Euro First 300 down 0.8%, but banks underperforming sharply, down more than 4%. And that's Eurozone banks down more than 4%. That's the European Market Pulse today. Join me again tomorrow at 12 GMT. I'm Jamie McGeever. This is Reuters.